This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Hello to all our listeners on our GFM Wealth podcast. I'm joined by our senior financial planner today, James Malliaros. How are you,
Patrick?
James?
Good, thanks, Patrick. Yourself?
I should introduce myself. I'm Patrick Malcolm. I'm a senior partner at GFM, and we're joined by Ryan Quinn, who's a client portfolio manager at WCM.
Hi, welcome. Happy to be here.
That's good.
Yeah.
First international podcast guest, James. This is very exciting. Sometimes we have people coming from interstate, but Ryan's come all the way from Laguna Beach in California to join us. Just us specially, Ryan, is that right?
Exactly right. Well, I was told that the translation would be easy, so you guys understand what I say, and I'm going to speak slowly as I typically speak fairly quickly, but happy to be here and love the Australian community.
So for our listeners who aren't familiar with WCM, could you perhaps give us an introduction to the firm, its business, its culture, its history, those sorts of things?
Absolutely. So WCM is an investment management firm based in Laguna Beach, California. We have about $120 billion under management. Our focus is global equities, and today we'll be talking mostly about our global fund, which is about $34 billion of our total assets under management US dollars. It should strike people a little bit odd that we're in Laguna Beach, California. Mm-hmm. It's not exactly a financial hub of the world.
No, it's not New York.
But it's something we embrace wholeheartedly. Part of the thing that makes us different is that we're willing to be different. And I think that should lead expectations for differentiated outcomes from our investor base. And so when we chose to be in Southern California and kind of disrupt the financial industry, we decided also to approach investing in a bit different of a way. Now I'll contradict myself for a moment here and say, when we take the world of stocks, the All Country World Index, and you have to funnel it down to a certain point and be able to select some stock from that to create a portfolio. So we do similar things as other managers and look at quality metrics, right? So businesses that have high and rising return on invested capital, potentially little or no use of debt, history of free cash flow, history of a strong competitive advantage, or typically a very strong brand in the marketplace. And that's something anyone can do. So nothing different there. And then we build a portfolio of attractively priced businesses that have a runway of growth, right? Again, nothing earth-shattering there. Where we do differentiate is how we've developed our views on competitive advantage. And we have learned lessons in the past from businesses that were wide moat businesses, taking a note from Warren Buffett's idea of, an asset is sitting in the middle and the moat is around it protecting that asset. And so there are cases where owning businesses that simply had a wide moat did a disservice to investors. We've made those mistakes in the past. And so what we've held ourselves accountable to in our fundamental work is to find businesses that we can make the case that their competitive advantage is growing. And we'll identify the drivers of that competitive advantage. And so if you take the moat example, we want to find businesses with moats that are expanding. And if they stall or they contract, that's a sell decision. And so we're always looking for businesses that have tailwinds to them, whether they're global tailwinds, industry tailwinds, but then also specific underlying drivers that are going to grow the fundamentals and create durable growth over time. And the next piece that makes us extremely different is WCM has benefited significantly from our own focus on our corporate culture. We have very strong internal values, and we have a chief culture officer, and we hold those values quite dear. The first being fun, second being gratitude, and the third being serve others. That might not sound very financial oriented to most folks, but what it's enabled us to do is to create a firm of very talented individuals who love working together and genuinely care about each other. And what we've found is that has paid us back in dividends beyond what we could have ever imagined. So over a decade ago, we said, is there a way to turn this culture view onto the investments that we're making? Look at these companies. And now granted and admittedly, it's a qualitative, warm and fuzzy type of endeavor that many speak lip service to, but don't really put any sort of fundamentals behind. But we've found that has significantly helped us in all aspects of portfolio management, whether it's buying a stock, selling a stock, adding to it, trimming it, just simply holding it through a difficult period by understanding the corporate culture. And so we've dedicated a significant amount of resources to our culture work by having a team of 4 individuals who are specifically focused on culture work. And they don't just walk into a company and say, is it a cool company? Would I like to work there? They're exercising a framework that we've built over time with academics from areas like Harvard. A gentleman named James Heskett wrote a book called The Culture Cycle, which was a really important book that pointed out the correlation between corporate culture and business outcomes. And so from that work, we were able to build our framework on how we look at corporate culture.
Understood. Not the toughest place in the morning to wake up when you have to go to work?
We like to say our employees skip to work, and you can partially do that because it isn't heaving down rain very often or snow or any sort of inclement weather.
Very nice. Ryan, let's do a little bit more into the investment philosophy that you've got and you've just talked about. So one of the things that you mentioned was about not just choosing, an important part of your investment philosophy is not just choosing companies that have got an economic moat, or what we call a competitive advantage, but one that's got an expanding competitive advantage, a moat trajectory, as you said. So can you talk a little bit more about that and how that affects your investment decisions? Really interested to know how that all plays out.
Sure. We take a long-term view of all the investments that we make, and when we also manage a fairly concentrated portfolio of 35 to 40 stocks. So effectively what we're trying to do is pick the 40 best ideas we have in the world. And so what's going to matter in getting us high conviction and going to get us excited about an idea is what the durability of the opportunity looks like for that company, right? And so if there are underlying drivers that we understand that are going to push a company to consistently outperform, consistently perform well, regardless of headwinds or tailwinds in the marketplace, then we get excited about owning it from a moat trajectory perspective. And we've always cared about the competitive advantage of the company. And the trajectory is something that helps us conviction weight ideas and really make the choices between something that's in the portfolio and something that's on the sidelines. And there are times when a moat trajectory is somewhat playing out, and it just becomes a company will become a source of funds. And then something on the sidelines that might be strengthening or have a steeper moat trajectory will likely come in and replace that. And so it's a very collective effort from our entire team. We have no superstars on the team. Everybody works together arm in arm and really row in the same direction to make sure that the fund and the firm overall performs well, rather than caring about their underlying kind of star status or whatever their individual stock is doing.
Okay.
Ryan, you talk about culture, and I think the way you described it was around being warm and fuzzy, and I think most people would agree with that. How do you quantify culture? And I guess what are the key attributes that you look for in terms of culture for strong, adaptable businesses?
Yeah, it's a tough thing for investors to wrap their arms around because we don't have a number score, a letter score, a color score. Yeah. It's truly relying on this framework that we have to go into any individual company, whether it's a trash collection business in Canada, or it's a semiconductor fabrication facility in Taiwan, or some niche industrial, right? So we invest in a broad set of diverse industries and business categories, and we have to have a framework that is applicable to all those different companies. So when we initially went into it, of course, we made a mistake and we sort of said, okay, well, is it just a cool culture? Does it impress us, right? Yeah. And that wasn't enough. And so the framework that we ended up building over time is a sort of three-legged stool. The first leg of the stool is alignment. We believe that company culture will define employee behavior. Employee behavior will define business outcomes. And so if you can get to a culture that is aligned with that company's specific competitive advantage, and again, it goes back to the fundamental piece, firstly, identifying a company's competitive advantage. If you can identify that competitive advantage and then look into the culture and say, what are the ways that this culture is aligned with supporting that competitive advantage? That's the first piece of the puzzle. The second piece of the puzzle comes with culture strength. Corporate culture has to be understood by every single person in the firm at every level. And so long as that is understood and widely held, then we will deem the culture as strong. And we get to that by interviewing the executives of the company, but also we will source through expert networks former employees that have left on good terms. And we pace them through a proprietary set of questions that dig in to try to really understand the source of the company's competitive advantage, how the culture supports it, how broadly it's known through the number of interviews. If the answers rhyme, then we believe that culture is strong because anyone can recite the core tenets that are on the wall in the foyer, right? But it's really about what types of things animate employee behavior. And then the last piece is adaptability. We're buying businesses and holding them for a long time. Over that time frame, there's going to be external threats and internal threats as the company grows, whether it's increased headcount, a competitor coming in with a similar product, you name it. But an adaptable culture will take that and be able to power through and support the business through. And so in the end, when we find businesses that we can identify drivers of a positive moat trajectory supported by well-aligned, strong, and adaptable cultures, that's a business we get extremely excited about and we'll put in the portfolio.
Intuitively makes sense, and I think you're making it sound a lot easier than what it actually is, but thank you.
And I think it's important to note that, by putting resources behind it, really committing to it, and doing it day in and day out, allows us a library of knowledge or an institutional foundation with which we can draw upon.
Yeah.
Because if you just pay lip service to it and say, what's your culture like? Any CEO is going to give you some beautifully flowery discussion about the corporate culture and how great it is, right? Yep. But there's nothing fundamental about that, right? And so for us, being more inquisitive, trying to really dig deeper, ask questions, listen to answers, and ask follow-on questions, it does allow us to get a differentiated perception of what the fundamentals are telling us in the numbers side.
So, Ryan, if we bring it all together and you see those two major pillars of your investment philosophy around competitive advantage or an expanding competitive advantage as well as culture, the two are complementary. So how do you bring that together in terms of how that influences your investment philosophy, how that also affects your stock selection and the way that you choose companies to invest in?
Yeah, I think they're probably best described as hand in glove, right? Yeah. Because the moat trajectory culture piece, in different instances, moat trajectory has driven an investment thesis, and culture work has supported it. In other cases, culture work has been a significant contributor to getting excited about buying a business. And you can think about it this way: CEOs no longer work for companies in general for 25 or 30 years at a time. They have, similar to kind of athletes, they tend to have a shelf life. So we find great businesses that we are excited about, and when there are executive level turnover or there's a internal change that we can identify, typically going in and trying to get fundamentals on that, numbers, is not going to make a difference. If you can send a culture team in to try to understand what the potential changes are, where the focus is going to be, what's going to happen to the employee base, will it grow, will it shrink, how will things be divided, will levels of bureaucracy get eliminated, that's a way for us to then gain greater conviction in the underlying fundamental thesis. So they can work in tandem, they can work side by side, they can work one over the other, and we never really try to dictate which way it goes. Our culture team works side by side with our fundamental analysts. Frequently when we speak with CEOs and other executives, there's a mix of us in the group. So everyone gets to kind of hear the things they need to hear, and we come back together and discuss how it impacts our existing thesis or the potential to buy or sell a name.
Now, one of my favorite things to do, Ryan, is to ask a stock picker about the macroeconomic environment, because they always seem to want to refuse to answer questions about the macroeconomic environment. But nonetheless, I don't think we've been in a more confusing macroeconomic environment, interest rates, inflation, geopolitics, all these sorts of things. Without delving too deeply into those factors, how do you strike the right balance between considering the macroeconomic environment, but also stock picking as well?
Yeah, there's a few things I would say to that. First off, we are very outspoken about being poor at predicting the macro, so we don't do it, right? I mean, we're not that manager that's here saying we think on June 1st interest rates will be X or Y. It's not going to be what we excel at doing. However, to your point, being macro aware is very important because it does change the environment. And at WCM, we tend to say we take what the market gives us, right? We're not trying to change the environment. We're not trying to predict how it will change. We want to see how it is today and really assess how we're exposing our capital to that market. If we zoom out a little bit, going all the way back to COVID, COVID created a very specific macroeconomic rift that pulled forward demand in certain industries like healthcare and pushed out demand in certain industries like, say travel or aerospace. Yep. And then as we get into 2022, the advent of of very high inflation and an increasing rate cycle, that also changes the macroeconomic environment. And so we reacted to those things probably closest in 2023 when we were taking a hard look at what things performed well, what things performed poorly, not just in the last quarter or three, really over the prior decade. And what we came to understand was that there was a rising tide that was lifting all boats in growth. And what we didn't want to, the mistake we tried to avoid was expecting that tide to continue on or expecting what worked in the prior decade to be the things that push forward in the forward decade. And so we began looking for different business cycles and different areas of the markets that maybe had been underperforming prior to their COVID growth rate. And it specifically pointed us to areas like aerospace and defense, electrification, the grid. These are areas where we hadn't had much exposure in the past. I mean, prior to that time, we were very much e-commerce, cloud computing, a number of healthcare names. And healthcare specifically has gone through a difficult period here.
Very difficult.
Given tariff as well as drug pricing issues. So we are willing to be nimble and change the characteristics of the portfolio given what the market gives us, right? Without trying to be predictive or without trying to have the ego that says we know what's going to happen.
Do you view the macroeconomic environment now as challenging?
For certain arees, yes. I mean, like within healthcare, as I mentioned, it's extremely challenging. Absolutely. There are other areas of the market that are going to continue to struggle. But then on the other side, there are areas of the market that have really benefited from this change. I mean, the financial sector, some of the insurance businesses have really benefited from a hardening pricing environment, as well as the reemergence of reinsurance as an attractive business model that had been sort of asleep for a decade. And so, in any given market time period, there's going to be things that fall out of favor and things that rise to favor. And we take a very clear view of that and try to make sure that we are optimizing the portfolio inside of these business categories with the best ideas that we can and express them in a way that gives us diversification despite only having 35 to 40 stocks, and also gives us multiple ways to win in any different market.
Understood.
Okay. Ryan, you've got a good allocation of the portfolio to healthcare and technology. Do you see any secular growth opportunities that are driving those particular opportunities in those sectors, and what's causing those tailwinds that interest you in investing in those sectors?
Yeah, I think the complexion of the portfolio has evolved a little bit in the last 3 years. Healthcare has de-emphasized to some degree because of the challenges in that industry.
Yeah.
I guess the logical next question would be, well, where has that capital gone? And it's been into niche industrials. These are some of the business sectors and cycles that we're getting excited about. They're a bit more cyclical in nature, so less secular than kind of your comment. But our secular growers are really in our information technology sector. Okay. And there are quite a few trends that are going on within the tech sector that we're excited about very long term. Always, e-commerce, digital payments, and payment processing. If you think about artificial intelligence, there's the chip side of things. There's also the hardware side of things. Within tech, there's no shortage of cloud computing excitement in the marketplace. So these are all very well known to, I'm sure, many of your listeners. But I think the way that we choose to get exposure to them is a little bit differentiated in that we try to avoid picking the binary winner. Like we want to own businesses that we describe as picks and shovels businesses. So rather than being the prospector that's diving into the creek and spending all their money to try to find gold, we want to be the outpost that's selling them the picks and the shovels and the pans that takes advantage of this opportunity set, but isn't necessarily so far out on the risk spectrum that we risk utter bankruptcy.
Yeah.
Understood. Now, I think we sort of picked up on this trend before, Ryan, but there seems to be a little bit of an evolution in the portfolio construction risk management process in recent times. And I think this talks to your stock categorization process. Can you walk us through how that works at WCM?
So one of our return characteristics that we hold very dearly is our ability to protect capital in negative markets. And that's not through playing with cash or derivatives or anything. This portfolio is always fully invested with a target of less than 5% cash. But historically, when the markets fall, we capture less than the markets draw down. And then conversely, when the markets go up, we've been able to take more than our fair share of the upside. Historically, that's been through high quality businesses. It's been through a balanced portfolio construction perspective. And also it's by making sure that we had a diverse set of holdings in the portfolio characterized by defensive growth businesses, cyclical growth businesses, and secular growth businesses. And 2022 exposed an environment that was going to need more than just the classic WCM portfolio construction techniques. And so what we began to pay attention to was the correlation of the companies that we own in terms of what are they really exposed to. So if you think about this year in the first quarter, DeepSeek came out. It kind of sent shockwaves through the tech sector and artificial intelligence by bringing this large language model that used quote unquote dumber chips and less energy than some of the leading competitors out there. And the industries that were hurt the most when that announcement came out were companies that were tied to electricity, industrials businesses, right? And so unless you're really paying attention to these things, that doesn't make intuitive sense, right? So a company like Siemens Energy fell like 30% in a day. And they make wind turbines, gas turbines, and they have nothing to do directly with ChatGPT or any of the large language models. However, when you take one derivative away, these are energy demand businesses that now have a significantly better runway of opportunity because of the AI demand, in addition to just the general need globally for infrastructure increases and grid upgrades. So we now, in addition to all the things we've always done, one of our themes internally is think different, which I think we've kind of touched on, but also get better. Every single person is charged with every single day trying to get better personally, but also make their team better. And so getting better from the portfolio level means, okay, let's add some categorization to the portfolio. In addition to paying attention to defensive growth, cyclical growth, secular growth, in addition to paying attention to the position sizes we have, we want to then look at which companies touch which themes within the marketplace and really make it very clear and known to us that within artificial intelligence hardware we have hypothetically 7% of the portfolio, and it's expressed through these two names, right? And being able to do that will allow us to probably more accurately predict how our portfolio will perform given any sort of market volatility or upside.
Yep. The GIG sectors don't always give you a great sense of the correlation of businesses, do they?
It's one of the reasons we have business generalists as analysts, because if you it's our belief that if you get too close to the table and become too specialized, you're going to miss subtle changes that happen within a sector. And if you think about the financial sector today versus what it was 30 years ago, things change and evolve. And if you're too close to the mat, then you're not going to pick up on these changes and you'll never be able to
the technology sector where everything sort of tech related just gets lumped in and they're all very different. But anyway.
Exactly.
James?
Interesting. So, Ryan, you talk about healthcare and some of the challenges facing healthcare, and then obviously you also talked about protecting capital. Are there sectors, themes, or regions at the moment that you're avoiding just to protect the portfolio and protect investors' capital?
I think historically WCM has avoided, classic non-growth areas of the marketplace. So investors should not expect to see real estate, utilities, some of these typical non-growth sectors of the market within the portfolio. So that's going to be a perennial avoid, I would say. Kind of going back to my comments about taking what the market gives us, I like to kind of describe it more as what's being emphasized and what's being de-emphasized. Yeah. And within the portfolio today, over the kind of the course of the last 2.5 years, we've been de-emphasizing some of those healthcare names. Certainly de-emphasizing, if not eliminating, things that have some tariff risk to them. It hasn't been many, but that has led to some changes in the portfolio. And then emphasizing things that we think have very long-term tailwinds. The change that we've seen from a construction perspective in the global fund over this time also has de-emphasized the U.S. and now emphasized Europe. This year has been a real breakout year for ex-US markets, specifically in Europe. We see a number of very strong structural changes that are happening there that give us confidence that it's going to be a tailwind for some time. And, frankly, avoiding some of the higher valuation businesses that are sitting in the US is probably a smart thing to do just on a relative basis.
Yeah.
But what's exciting is Germany announcing its infrastructure spending bill, NATO nations increasing their defense spending from around 1 to 2% up to about 5% over time. These are very long-term tailwind opportunities for a number of businesses out there. And so that's led us to really bringing forward and emphasizing more industrials names than we've had in the past that touch aerospace, defense spending, as well as infrastructure spend and the grid.
Okay. Places like China, Southeast Asia, does that encompass things that you look at there, or you got concerns around those particular regions?
Absolutely. We are willing to build a portfolio of 35 to 40 ideas, the best in the world.
Well,
and now look, the bar to get in the portfolio is very high.
Yeah.
If as soon as we get further afield into emerging markets and areas that may have experienced increased volatility, we'll be a little bit more thoughtful there, and the bar might be a bit higher.
Yeah.
But again, if it meets the moat trajectory and culture needs that we want in the portfolio, then any company anywhere in the world is available.
Yeah.
China is a very specific opportunity set, right? It's a huge demographic market. There are really incredible trends that are happening within that country. We spend a lot of time there. We do have other teams that manage emerging markets portfolios, and we all work together as one WCM. So we're constantly scouring the globe for the best ideas we can find. China, Latin America, the rest of Asia is certainly on that list.
Ryan, a long-term winner in the portfolio. Can you give us an example of a long-term winner, the investment thesis, and perhaps how that ended up in the WCM portfolio?
Absolutely. We learned a long time ago that exposure to the consumer is best achieved through luxury. So luxury has been a theme in the portfolio for quite some time. And Louis Vuitton is sort of the poster child of luxury, right? It's a collection of star brands. The business has a phenomenal ability to control the demand characteristics of its products. Famously, they will destroy the supply of anything that doesn't sell rather than just putting it on sale, which many people would likely be happy to have. And it's effectively a very high aspirational quality good, which leads to durability of demand, right? I mean, when people are concerned about what are you going to do about raising interest rates, what are you going to do about increased inflation, the Louis Vuitton buyer is typically not concerned about that, right? They're going to buy their bag, they're going to buy their product, and so the company has done a phenomenal job of understanding that from their end consumer and doing a great job of managing their inventory levels, moving them around to different areas. If one area is weakening, they can move it to another area. And also by, again, controlling exactly what's released to the marketplace. The theme really within Louis Vuitton over time has been the worse the market, the better the company's gotten, because other weaker hands are not able to control price the way they can. They're not able to manage their inventory the way Louis Vuitton
seems counterintuitive, but
exactly right. And so that's one that we had held for well over a decade and was a tremendous winner for us. It was almost on autopilot. Now speaking of corporate culture, the corporate culture at Louis Vuitton is frequently described as ruthless, and that's to us right now that might make your hair stand up and say, "Gosh, I really don't want to work at a ruthless company." But it works for Louis Vuitton, and its employees understand that, and they understand that they have to be ruthless about their design, about their commitment to the brand, about their level of quality. And so that's a good example of a corporate culture that supports Louis.
Ruthless means perfection there, doesn't it?
Exactly right.
Yeah.
And I may not thrive there, but others, they'll rise to the top.
Yep. So there isn't a substitution to lower quality luxury brands in a distressed environment. It actually benefits a Louis Vuitton rather than hurting them, which is fascinating, isn't it, James?
Really interesting, isn't it? Yeah. We've seen it a lot, I think. We've spoken to other fund managers, and I think we sort of get the same message as well too. It's interesting.
Next question, James.
Okay. Investigating businesses and looking to buy businesses is probably the exciting part of the job that you do. But I'm sure you get to certain points where you've got to sell something, be it for valuation reasons, being it for the company hasn't performed anywhere near your expectations. Tell us a little bit about that, the difficulty of selling, and what are the triggers that causes you to sell?
I think what helps us take the emotion out of selling is our commitment to the moat trajectory piece, right? Really understanding the drivers of a company's competitive advantage and always being able to check in on those. And regardless of what happens with if it's a singular headline, if it's a spike in interest rates or any influence that will happen on any company, we can then revisit our drivers of moat trajectory. And in some cases, the company has a better position. In other cases, they're weakened, and maybe their competitive advantage is going to stall, which is enough for us to get out. Right? We're not going to just hold on to Louis Vuitton because it's a great company. Yeah. In fact, those are widely known inside our walls as the most dangerous words in investing. It's still a great company, right? That's the kiss of death. I mean, anybody says that, we get out of the position right away. But yeah, so really being able to lean on that time-tested fundamental buy process has given us a great sell decision as well.
So over the years, you've been investing obviously for many years, and the experience of it is quite large. But to the extent what's the biggest lesson you think you've learned from the years that you've invested?
Gosh, I think the biggest lesson I would probably share with investors is it's not about timing the market; it's about time in the market, right? Because when you entrust a money manager to act on your behalf and allocate your capital into companies that, with the expectation of growing that capital, you have to give them time to do it, and you have to match their time horizon. And so for us, when the markets get volatile in 2022, it was an ugly year. I mean, everything was against growth investing. There was a war going on. There's rising interest rates, and continually, like you didn't know much about 2022, but you knew rates were going up continuously across the year.
I think people forget how bad it was.
It was, and I think that if people could have seen our team working together and showing up to work, it's encouraging because we view that as a massive opportunity from everyone within the walls, from our CEO to everyone across the company was encouraged to be extremely excited about what was going on. Now, it's never fun to see negatives on your return, and we take serving others being our third core principle. We know we're losing capital for the people who trust us with their investors, with their investor capital. But at the end of the day, what we did in that environment has paved the way for the returns we've had coming out of it. And we can never forget that these periods of volatility are, to some degree, a bit of a painful gift. Because we are going to be able to reposition the portfolio in a way that can produce very long-term returns. So I think being time in the market is going to be the key for everyone. Right. Of course, choose your investment managers wisely. You have to understand what they do, how they do it, and how consistently they'll do it. If you can find a manager that will be very consistent in terms of their philosophy and process, but of course adapting with times. But knowing what they'll be doing, then you just have to kind of buckle up and say, all right, this will work out in the long run.
Understood.
Interesting.
Now to end with, Ryan, the elevator pitch. Can you tell us, to close off, what is it that an investment in WCM adds to a client's growth allocation in their portfolio? Why should a client invest their money in WCM?
Gosh, I'm so conflicted here because I'll try to answer this a bit diplomatically. Well, when I think about investors and they're diversifying their capital across different asset classes, whether it's fixed income or equities or maybe some alternatives, obviously their allocation decision is going to be where they're willing to extend risk and where they want to protect capital. I think when you think about WCM, you're going to get a concentrated manager that is invested in high quality growth businesses for the long run that will touch a number of different business teams across the world. We avoid skating out too far on thin ice. We try not to be a one-way bet type of manager. Mm-hmm. We try to create an all-weather portfolio that should perform well in your overall investment scheme over any time period. And we do it consistently. Our team is incredibly consistent. We have very low turnover on our team. We have 97 employees and 63 of us are equity owners in the company. So we have very strong alignment together. And then I think the most important idea is that we never feel like we've figured it out. We're never going to sit back and say, we've got it done. We're good to go. We're always going to be trying to put forward the best portfolio we can. And investors tend to choose either using a WCM as the core of their global exposure, and then maybe supplement it with some ETFs for low cost beta exposure, or the opposite. They want low cost beta exposure to the market, and then they'll have an investment in WCM to add some concentrated active management. And both ways are perfectly suitable, and they make us happy. We don't care either way.
Yeah.
But I think that if I was advising a client, that's kind of the way I would perceive an investment in WCM.
Perfect. He answered it like a financial planner, James. How good was that?
Bring him along to the office. Good.
James, thank you for joining us today.
That was great, Patrick. Thank you.
Thank you, Ryan. We really appreciate your time.
Ryan.
Cheers. I appreciate you both.
Thank you.
Thanks.